welcome to this episode of FTI Treasury Talks, where we will discuss mark-to-market valuations of derivatives, the intricacies of those valuations and the differences between the valuations provided by your counterparty banks and those that might be valued by your system or by a market valuation process. My name is Marie Clarke and I'm the Head of Finance and Corporate Services here at FTI Treasury. And I'm delighted to be joined today by Marie Gaynor, who is our manager of the middle office team. Marie's team have responsibility for reporting mark-to-market valuations and the accounting for those valuations. So without further ado, I'm going to start asking questions directly to Marie as she's the expert. So Marie, you might give us a little bit of background, I suppose, of the purpose of these valuations and the benefits and uses to the various teams, like the Treasury Accounting team, for example.
Sure, Marie, and it's great to be chatting today on a topic that a lot of clients have an interest in recently. So when a company enters into a derivative, the bank that is the counterparty to that derivative sends out valuations periodically, usually at month end, sometimes weekly. And these valuations are really important because derivatives have to be fair valued in your accounts. So the value of your derivatives is really important in your financial results.
Okay, good point. So as well as the uses then for the Treasury Accounting team, would there be any other benefits to any of the other teams for these valuations that are provided and the details of those effects? I'm saying FX, but I guess any derivative, that would be included on it. Are there any other uses or benefits of that?
Yeah, well, it's really important to look at your bank valuations that you receive and just make sure you're happy with the details. There's a lot of detail in there. And even though the trade would have been confirmed at inception, it's really good to check just that you're in agreement with the bank, but with all the details of the derivative, the maturity date, the nominal. There can always be things that can kind of go slightly out of sync. So it's a good idea to see that all your details are correct. Also, if you're using a system to produce a valuation of that derivative, it's always really good to see that you're using similar market rates and inputs to calculate that valuation. They're always going to be a little bit different, but there's really useful information in there, and they can be quite difficult to understand sometimes. There's a lot of information in there. You have to have a little bit of knowledge of derivatives and how they work and how the valuations work to be able to read it, but it's well worth going through and understanding.
Yeah, fair enough. And then I suppose, like for companies who might consider just using the bank valuations, like is there any sort of things that people should consider about not using an alternative valuation and just focusing and just using on that bank valuation?
Yeah, so there can be different market rates that can be used in the valuation, and you really need to look at what's being used, particularly maybe whether it's a clean or dirty price, so whether the accrued interest or the forward points are included in it. What if there's a foreign exchange element, what spot rate is being used, and even if you maybe don't consider there to be a foreign exchange element, if it's like an interest rate swap, it could be that you're a US dollar company and the bank is more a euro-based company, so you really have to check that you're interpreting the results correctly. Also, the bank might give you the valuation from their point of view, and you have to remember to look at it from your own point of view.
That's a really good point. So then really, are you kind of saying that like a systems valuation, maybe a market-based valuation system should also be used in conjunction with that?
Yeah.
If you have something to compare it to.
Yeah, especially for treasury centres and big global companies who would have a lot of derivatives. Maybe if you're only trading maybe one forward a quarter or something, maybe it's not worth having a system. But if you have a number of derivatives and you're using a treasury management system, it's a very good idea to try and produce valuations out of this system. So you can apply a standard methodology. You can use the same rates, like, for example, foreign exchange rates, as you're using to value your underlying instrument. This is really important for, say, if you're applying hedge accounting and you want to see if your derivative is effective, you want to use rates on the underlying and the derivatives that are as close as possible, so you get as close a match as possible and less noise from in your P&L, even if you're just fair valuing them.
Okay.
Yeah. Also, a big benefit is that you can produce your accounting entries from the system and bring them into your ERP.
Yeah, a benefit for integration.
Yeah, absolutely. So Treasury Management System can generally produce the journal entries, and they can be straight through loaded into your ERP. So much quicker, much more accurate, and less chance of any issues. And it's just much quicker way to get your information. You don't have to try and interpret, emails or spreadsheets that are coming in every month.
Lots of different sources, lots of different formatting and all that, and trying to consolidate the whole lot of them. So then in terms of using a valuation system or using your treasury management system, if you're using your treasury management system, all your details, all your deal details are already stored on that.
Yeah.
What other information then, other sources of data might you need to incorporate into your system to get these values?
Yes. So if you have a treasury management system already, you're going to have your transactional data in there. You also need market data in order to be able to produce the valuations. So a big thing would be yield curves, interest rates and yield curves. There can be different yield curves used by different banks. So you might want to just have given consideration to which one you use. Also, you need your FX rates. And that's really it. Like mostly your curves are a very important thing. Yeah.
Does sound like a lot of work. Is it a lot of work? Is that just on implementation?
So if you have a treasury management system already, you're probably bringing in a rates feed. For our clients, we have a treasury management system. We bring in a daily rates feed that has all that information in it. We then set up reports, which can be then run instantly, at any time to get a valuation out. And the transactional data is already there. So it's really quick once it's set up. And the setup really isn't that onerous. It's just really take some time to ensure that you're happy with the methodology behind it.
And there's loads of benefits, obviously, then having that. I mean, you've explained a few of them.
Yeah.
So either you would probably suggest, commonly, what do you see across the clients? Because, we've got clients across the globe. They use a variety of different counterparties.
Yeah.
So what would you see commonly used across?
So mainly we would see the treasury management system producing valuations, and then usually at reporting dates like year end, maybe you would check that you're happy that the results are broadly similar. But it can have really big benefits across our clients because, there is a market trend towards moving to hedging on a net basis, where the Treasury Centre hedges for all the subsidiaries rather than
on a net position.
Yeah.
Interesting.
So that can be really useful then, because obviously all the subsidiaries need to report their valuations individually, but the bank is only going to give you a valuation of the transaction that you've dealt, which is the net position. So if you're using your treasury management system, then you can have the transaction with the bank input there, but you can also have your back-to-back transactions into the different entities all around the world, and you can easily and quickly produce reports and journal entries for those smaller entities to be able to post into their accounts. And a lot of these entities are, their business is not really treasury. They're maybe have a few derivatives or a small hedging position, and you have much better accuracy and control over what's being posted into their accounts.
Great. That's really interesting. It's a really big benefit, obviously, then of using either your treasury system or, if necessary, a third-party service provider. So then, in terms of all of those benefits, like there probably is a bit of cost involved. Would you say that outweighs the effort that goes into setting up a system, managing it, maintaining it? How would you sell it to somebody if you were to
So I would say it definitely does if you have a volume of derivatives, especially if you're net hedging, because you can very quickly and very easily get the valuations out. You don't have to wait for these emails to come in from the bank every month. Then find someone who can interpret them correctly, who can create manually the postings into your accounting. Also maybe just, check the methodologies to make sure your auditors are happy. It's all already automated, and although there's a little bit of work setting it up, from then on, it's really easy.
Okay, very good. You just touched on a point where I was about to ask about the auditors and if you have seen what they're happiest with, or is it just something that you should discuss with them to be sure that they're comfortable with the valuations if you are using the valuation system?
As with any process that you're setting up new, you should really discuss it at decision-making stage with your external auditors, just to make sure they're happy with the process and with the methodology that you're using. But once they have seen the reports and once they are happy that they're broadly in line with the bank's valuations. They're generally very happy to use that companies are using the system.
Okay, very good. And actually, one last point is on hedge effectiveness and hedge accounting. I assume there are benefits then again. You know, we were talking about the bank valuations and how they may be using different FX rates versus what you're valuing your exposures to. So presumably there is then benefits from a hedge effectiveness and testing of that point of view.
Yeah. So you'll have your mark-to-market reports and valuations that you can produce from your treasury management system, and you can use that as part of your hedge reporting and hedge effectiveness reporting. And it's going to be much more accurate because you're going to be using the same rates all the way through your treasury management system for both your underlying instruments and for your derivatives.
Okay, perfect. Thanks, Marie.
Thank you.
Yeah, that was great. And thank you, Marie. I hope everybody enjoyed that chat with the experts. And if you have any follow-up questions with us, we're more than happy to answer those. You can contact either myself or Marie through our LinkedIn profiles, or please visit our website on ftitreasury.com, where there's a wealth of information. We've numerous resources. We work with clients globally, so we have lots of experience in terms of these mark-to-market valuations and the reporting for such. So we'd be very happy to answer any questions that you might have. Thank you.